I moved to China, to Shanghai, in 2007, and I left China 11 years later in 2018. In that period, and in the time since, a huge amount has changed in China and in the global perception of China. In 2007, China's population was still relatively young, and its workforce was growing. Real estate was booming, and trade and technology ties with the United States were vibrant. Tensions in the Taiwan Strait, well, they didn't go away, but they weren't top of anyone's worry list. Fast forward to 2023, and the situation has significantly changed. There are certainly some big positives. China continues to innovate on sustainable energy, on electric vehicles. Xi Jinping has cracked down on corruption, and the Belt and Road Initiative has put Chinese capital and expertise to work around the world, driving economic development. But on those big macro factors, things have changed, unfortunately, for the worse. China's working age population is shrinking. China's real estate sector is in a significant correction. There are new and significant barriers to trade and technology transfer between China and the United States. And tensions in the Taiwan Strait, well, they've seldom been higher. Put the pieces together, and it's really no surprise that China's growth, which in 2007 was comfortably in the double digits, will in 2023 come in at around half that. 5% growth, not bad in international comparison, but pretty lackluster compared to China's recent history. So, time for a re-evaluation of the China story. And who better to help us with that re-evaluation than our fabulous panel? Fred, let me start with you. China's property sector, once the biggest driver of growth, is now in the middle of a serious correction. How far does that correction still have to go, and what are the costs going to be for China's economy?
Right, Tom, I think your opening remarks are really a very pessimistic case, about China. But I think you're right, at least on property. Okay, property saga in China is still unfolding. Home prices in major Chinese cities have been falling. Many of the country's biggest property developers are teetering on the brink of debt defaults, falling sales, liquidity crunch, and under tremendous pressure to restructure and repair their battered balance sheets. So the property, definitely I don't see the end anytime soon. I think what's happening in China is quite different from what happened in the US during the subprime housing crisis in 2007-2008. That was, if you recall, was pretty abrupt, full-blown and violent implosion, with the global financial crisis. What's happening in Chinese real estate, I think it's a multi-year process. Okay, it's more like in Japan, the real estate crisis in Japan in the 1990s, be the slow motion crisis. So, China will have to deal with this problem, for at least a few more years to come.
Thanks very much, Fred. When you started by saying, Tom, your opening remarks on China, I was hoping the next words were going to be, were extremely insightful and completely correct. So I was a little disappointed to hear I was off base, but thank you for your insights. Ben, we've heard Fred touch on the risk of a pass-through from property correction to financial crisis. And Fred touched on the examples of the Lehman shock following the subprime crisis in the US, and of course, Japan's lost decade in the 1990s. You're managing trillions of yuan of investments in the Chinese system. How are you thinking about those risks? Should we be worried about property crisis, sagging into financial crisis, or are those fears overblown?
Fred just mentioned about global financial crisis. I was AIG's regional risk manager for Pan-Asian businesses back in 2008. I still remember that day. I was worried about my job next day. And coincidentally, you just mentioned something very interesting. I moved from New York to Hong Kong in 2007 when you moved to Beijing. I started working for mainland China company in 2018, and you just moved out of China. It was such an interesting coincidence. What I'm thinking is the property market in China needs a correction because there was a bubble. There was heated momentum in China. But from investors' perspective, I run large portfolios. My total portfolio under my management is like 4.6 trillion RMB. That's really, really large. And what I need to do is to stay stable with my allocation strategies and run through the jugular cycle. Look, every economy has a cycle and run through different cycles. And we are just in the cycle of a lower phase of that cycle. We were at the peak and coming down to the lower part of the cycle, and it's going to come out of that one. How fast will China's property market come out of the trough? Different parts of the property will behave differently. You got old traditional residential housing. It could have a long trough, could have a long period of being cold, but also we have multifamilies. We have rental properties that are really trendy today. We're investing more into those kind of properties. And also the quasi-real estate, we got infrastructure, we got the logistics and the industrial parks. All these things are also real estate type of investments that we are really interested in. And coming back to your question about how China will be compared to Japan, I did some really in-depth studies before just to make sure, compare the two countries. There are a lot of similarities, of course, but I think there are some key differences. China has a bigger economy and more diversity in terms of the composition of the economy, of the macroeconomic structure, and the depth. And also, there's one more thing, that the policy, execution of policies in China is quite efficient and effective. So, I want to quote the governor of CSRC, Mr. Yi. What he said before was that, in one of the conferences, he said the policies will come out gradually. So I think the government will take a very measured approach, not to flood the market with all kinds of policies that people don't have direction with, and will test the water and make sure things don't go overly corrected, and eventually the sentiment will turn. So I think it's a measured policy action with careful investigation on the surroundings and with very solid execution. So within a few years' time, I think I'm positive it's going to come out of for better. Thank you.
Gary, property is part of China's old economy. You're an investor in China's new economy. Where do you see the innovations? Where do you see the opportunities? Where are you putting your money to work?
Yeah, I think if I drew one comparison to Japan, since we brought up Japan, Japan really had no innovation society. China has been entrepreneurial driven now for the last 20 years. When you look at the economic development, virtually all the new growth has been in private companies. The profit growth has been in private companies. Entrepreneurs have driven virtually all the innovations. They're not coming from the SOEs. And so there was a great deal of money that came in. Foreign money initially funded a good part of the innovation that occurred in China. That's now being transitioned to RMB. So 90% of venture capital today in China is RMB. When you look at 3 of the last 5 years, the Chinese stock market generated more exits in both dollars and number of deals than the US stock markets, which is not something people would have expected 20 years ago. So the innovation economy in China is actually quite robust. and it's very broad. It's affecting the healthcare system. It's going to occur in semiconductors, partly because of U.S. policy and partly because of just the native skills that are there. There are areas that are more challenging, enterprise software and things, but advanced manufacturing, AI, biotech, drug development, cell therapies, gene therapies, these are all areas that are going to be very, very robust in terms of venture capital investment going forward. The other piece I would add, just very briefly, is that dollars going into China have declined, but they've declined globally. In 2005, the U.S. and China together combined for about 84% of global venture capital. Today, they combine for 83% of global venture capital. And it's quite staggering when you think about the amount of money that's gone into private equity and venture capital, that two countries still control that. The only two countries in the world that are complete ecosystems from sourcing capital, funding entrepreneurs, growing companies, exiting, are China and the United States. That's not going to change anytime in the near future.
Jenny, China's rise as a technological power is clearly a huge positive for the people of China, helping raise standards of living for 1.3 billion people. How does it look from the US perspective? We see the Biden administration moving to constrain China's access to leading-edge semiconductors, for example. Many people in Beijing view that as going beyond national security and actually as an attempt to contain China's rise as a technological power. You recently joined Bloomberg from the White House, where you worked on China policy. How should we think about it?
No, I think that's right. We're watching a major shift in how the U.S. approaches technology and China, and I think it reflects a shift in how the U.S. looks at China, but also its own economy. So for decades, the U.S. has had policies in place that restrict China's access to tech that is primarily used for military applications. But recently, we've seen Washington become more concerned about the role of technology leadership and the impact it can have on industrial capacity and on the workforce. And that's really become a consensus across both political parties. And they've shifted away from kind of the traditional neoliberal approach to technology and economics and trade. You add to that the lines in technology itself are becoming more blurred. There's tech like advanced semiconductors that has military applications, but also important commercial applications. And then additionally, you have the blurring of the lines in terms of who is developing and using that tech with civil-military fusion. And you combine all those factors together, and what we're seeing is a real expansion in U.S. policy away from the really narrow target on military end users and military applications to things like the CHIPS restrictions, which are targeting tech that is used commercially, it's used by commercial end users. I think because those underlying concerns and those underlying structural factors are persistent, and this is the policy that began in the Trump administration but has continued under the Biden administration, very strongly supported in Congress, and China's continuing to make progress despite those restrictions, I think Washington's going to continue this approach, and that metaphorical fence is going to continue to go up. The metaphorical yard is likely also going to expand.
Gary, your perspective on that. Is the fence the right height or too high? Is the yard too big or too small?
So I think the fantasy of industrial policy should have been laid to rest a long time ago. Japan had an industrial policy. Didn't work out so well. China's industrial policy, I also think, hasn't been terribly effective. They announced a major consolidation of the steel industry in 2002, and they went from 54 steel companies to 52 steel companies in 17 years. So, industrial policy is simply not the way to go. The U.S. now has to go through the process of understanding that and how much money that'll waste and the inefficiencies associated with that. So we are unabashed supporters of entrepreneurs. We're unabashed supporters that the private sector at the point of the spear is where the changes are going to occur and where the innovations are going to be developed. The government can backfill and support from behind, not picking the winners as companies, but picking sectors that are strategic. And China has selectively done that, I think, quite well. I think that the U.S., when you look at the CHIPS Act, they loaded it up with so many things that no one wants to take the money. 15 months later, not a single dollar of the CHIPS Act has been deployed because the companies don't want the money because of all the bells and whistles that the government associated with it. So industrial policy is not going to be the path to success for the United States. It hasn't been the path for success to China.
Jenny, let me come back to you, and we'll stick with the subject of US-China relations. Now, there's a mystery as to why President Xi and President Biden decided to meet in APEC when there's a perfectly good international summit taking place in Singapore right now. But there we are. Xi and Biden meeting in APEC. What do you think is going to be on the agenda? How are your former colleagues on the National Security Council going to be briefing President Biden ahead of that meeting?
I think there's a lot on the agenda. This is the first time they will have met since this time last year at the G20. And there's a lot that's happened in the world since then. So I think they'll be talking about global events, the ongoing war in Ukraine, now the war in the Middle East, where both sides really have a major stake in not seeing that conflict boil over. Taiwan, I think, is going to be on the agenda, particularly with the upcoming presidential election. This is something that both sides are watching closely. They're watching what the other side is doing on it as well. And then I think a huge portion of the conversation will be about the bilateral relationship. Since they last met, both sides have taken steps that the other one doesn't appreciate, the CHIPS restrictions being certainly one of them from Beijing's perspective. So I think there's going to be the traditional exchange of complaints on that front. But I think the most forward-looking part of the conversation is going to be how are they managing those tensions, because they're not going to go away. And in that respect, I have pretty low expectations for major deliverables. I just think we're past that paradigm at this point in time. But we could see them look towards other mechanisms for managing that relationship, managing the competition, new working groups and dialogue mechanisms, which don't sound very exciting, but are actually pretty important for stabilizing the relationship.
Fred, your perspective on that upcoming Xi-Biden meeting and the broader US-China relationship, how do you see that evolving in the years ahead?
Well, what's really troubling is the last couple of years, there's been a shouting match across Pacific, right? So now the leaders actually are engaged. They're talking, the meeting and the ministerial meetings. Yes, we still have a lot of differences, but we also find ways to work together as necessary. So I'm hopeful the summit will really dial down, the tensions by several notches, and then, both sides become more pragmatic, focused on the areas. Of course, they'll have differences, but also areas that there are shared interest and, shared challenges like climate. So I'm definitely hopeful and encouraged by the willingness of both sides, to engage. Just, that's a good sign.
Certainly the flurry of visitors from DC to Beijing, Yellen, Blinken, Raimondo, of course, Vice President Han Zheng's speech today at the forum, and now the upcoming meeting between Xi and Biden.
And Mr. Bloomberg.
And Mr. Bloomberg, of course, do signal. I should be the person congratulating Mr. Bloomberg.
That's right.
So do signal that there is an attempt to put a floor under the relationship and to bring some stability. So a hopeful sign. Ben, let's bring the conversation back to China. We've talked about the slump in the property sector. The property sector, of course, is a big chunk of the economy. And we've seen Beijing move stimulus into place to try and offset the drag from property. We've seen rate cuts from the PBOC, fiscal stimulus. Is it enough, or do you think more is required to stabilize China's growth this year and next?
I think the policies are coming out gradually, and I think there will be more policies coming out. And looking at the interest rate level in China, it's lowered, but it's not low enough. That's my personal opinion from a macroeconomist or investor's perspective. I think China still have way to, on the monetary side and also fiscal side, more tools in the box. And, just going back to, I did want to comment on your previous question about US-China relationship. I think as investors, we have been waiting for that meeting for a long time. I think it's happening eventually. Great news. And it's a bullish signal for the equity market. And so I think if we look at the U.S. rate cycles and the European rate cycles, Japan rate cycles, lower rates will follow the higher rates, and eventually it's going to come up. So China is going into a lower cycle of the rates, which will be bullish for equities and the real estate sectors. So we're just for large money investors like us, we have a balanced portfolio. We want to sort of touching the water and to see which part is going to come low and which part is going to go higher. We pre-allocated money to rates, which was the very right call, and now the rates are coming lower. We are allocating more into the risk assets, which we feel is going to have a better performance next year.
Fred, we heard a little bit on China stimulus from Ben. I'd be interested in your perspective, both on the short-term and the long-term priorities for China's economic policy. Short-term, what more do you think China needs to do to stabilize growth into 2024? Is it more from the PBOC, more on fiscal policy, both? And thinking further out, what are the structural reforms that need to move into place so that China can prove the pessimists wrong and sustain growth at a steady pace into the 2030s?
Yes, the answer is all above. There's still vast scope for policy actions. Ben mentioned the real interest rate in China is still too high, given just how subdued the inflation is. And on the fiscal front, other than sub-national governments like municipal governments, but the national government still has a very strong fiscal position. So clearly a lot more can be done. But to me, the biggest upside is not from conventional cyclical policyism, rather from far-reaching structural reforms. China has been successful thus far, mainly because China has been pushing forward market reforms. And those reforms have really unleashed China's potential, particularly really rekindle the entrepreneurial class I think Gary talked about. But right now, Chinese entrepreneurs are lying low and lying flat. Sentiments are very weak, because people are not certain whether the leadership is committed to the kind of reforms. China has benefited so much for so long, and China will continue to need, to the next level, from a high middle-income country to a high-income country, fully developed, as President Xi envisions. So, that's what I will watch very closely, and in particular, really, I would say, among all the broad range of reforms China need, the single biggest priority in my mind is legal reform, is to really establish true rule of law. That's essential for the healthy functioning of modern market economy, which China is. Protection of property rights, protection of entrepreneurs from arbitrary political interference, and worse, even persecution. This sense of insecurity, in my observation in the Chinese entrepreneurial community, is really I've never seen this since 1978. So, if the moment that China really commits to rule of law and market reform, I do think the confidence will slowly but surely come back. Then the animal spirits will be rekindled. Then I'm quite optimistic, not only about the short-term outlook, which is 2024, which I think Tom, you want to ask about. I think China should be not really stretch to reach 5%, in 2024, but more importantly, over medium term, next 5 years to say to 2020, 2030, China should be able to achieve high quality, but also fairly high rate of growth, which is, I would say, 5%, just to China's per capita income. So China still, yes, short-term uncertainty aside, I think the pessimism right now, I think it's a bit overblown. China still has huge policy space to maneuver, and China has tremendous underlying potential, particularly the entrepreneurial energy that's still very much there.
Many people make the comparison between China and Japan, and Ben mentioned some of the reasons at the beginning of the discussion why perhaps those comparisons don't really work, and we should be more optimistic about China than the Japan comparison suggests. I think another powerful argument in that direction is thinking about what level of development Japan achieved before their growth significantly slowed. Japan's GDP in 1989 was about 80% of the level in the United States. Japan was already a rich country which had used up its development space. China's GDP today, well, it's grown really quickly, but GDP per capita is still a fraction of the US level, and that points to huge amount of potential in the years ahead. Gary, we heard you talk about the way in which entrepreneurs have driven China's growth, right? From entry into WTO and the rise of the East Coast export factories to the e-commerce giants like Alibaba and Tencent. Of course, the entrepreneurs have been a significant driver of China's development. But we heard Fred say, well, perhaps the environment for entrepreneurs has changed, and it's become a lot more challenging. What's your perspective on this? Has the Xi Jinping Common Prosperity Agenda really changed the story here? And if it has, what has China got to do to revive those animal spirits?
Well, I would say the Xi Jinping Common Prosperity has no hope of being achieved without the entrepreneurs in China. I mean, the one is not going to be able to exist without the other. I think you have an allocation issue, and allocations flow over time. In China right now, when you have over 70% of the consumer savings are in property, number one, that was a mistake to ever allow happen, and it's totally unsustainable going forward. Why does that happen? Well, it's because you have capital markets and a stock market that have basically been flatlined for the last 15 years. You put $1 in 2009 in the Chinese stock market, you have $1 today. Maybe you have $1.02, maybe you have 98 cents. And part of that is simply trust. And we're going to hear a lot more about that word, because when you do reform, you have to make sure that the reform is actually establishing trust. If the Chinese consumers don't feel comfortable, those hands get jammed in the pocket so deep, no force on earth is going to get them to spend money. Because historically, as families, pick whatever scenario you want to use, Cultural Revolution, et cetera, they simply won't spend. So the government policies of trying to increase consumption will not work unless they establish trust. The asset allocation that needs to occur in China is people willing to put money in the stock market from the property market, having the capital market be another sustainable long-term store of value. That is not seen that way today. And they've done precious little in the last 5 or 6 years to actually encourage people to do that. So entrepreneurs are fulfilling their job. I would say there aren't as many startups today, but what the problems they're trying to solve with technology, the depth of the technology innovation is very, very high. And the number of entrepreneurs is still enough. Again, 80-something%, China's 40% now of the global venture capital ecosystem. That's enough money, there's enough people, there's enough market demand. But they also need to establish a more sustainable capital market structure so that people don't think there's just one place to save money in China. And right now, that's the property market.
What would be one powerful signal that Beijing could send that they want to move in that direction?
I think, Fred probably knows the capital market structure better than I do in China. I would say that these market interventions that they do, where the government starts going in and buying stock, I think it's a mistake. I think the lack of quality analysis by most of the investment banks in China compared to their foreign counterparts is a problem. Allowing that market to open up so that the best bankers in the world could actually get in and establish a presence in China and support the capital market, I think would be I think would be good. So more competition in the financial services market from global players is something that was promised as part of WTO, but it really has not yet materialized.
Fred, do you want to come in on the capital market story? What's the unfinished business for Pan Gongsheng at the PBOC?
So China today is the second largest capital market in the world after the US. Both equity capital market and the bond capital market is all, north of 20 trillion. But unlike the US, there's not enough depth, not enough liquidity, not enough transparency. And also I would say there's not enough critical mass of institutional investors, right? So most of the national savings, as Gary alluded, is really scattered, by individuals and the mattresses or speculative into property and the like. So, to really unleash long-term contractual savings, insurance is a long-term insurance policy, but also pension. I'm sure earlier people talk about like demographic. Maybe not this something people draw the parallel between China and Japan. Demographic trend so starkly similar, but China actually has the opportunity to respond to that, by leveraging the national savings rate, more long-term saving for old age and pension, and with that, then Gary's can not just rely on sophisticated U.S. investors, pension funds. They can should raise money easily within China from Chinese pension funds and insurance companies. Because given the sheer size and the diversity and the opportunity set in China, it's not realistic to rely on international capital and confidence alone. You need to have enough domestic capital mobilized, for long-term investments. That would be a virtuous cycle, and I think there's opportunity there.
Jenny, we've talked a lot about risk on this panel. We've talked about risks in the property sector. We've talked about risks in the financial sector. But I think for many people in the world, looking in, they see one even bigger risk, the risk of a crisis in the Taiwan Strait. You ran Taiwan policy on the National Security Council. How should we be thinking about this? How big is the risk of a misstep triggering a crisis? And if one does occur, what's the impact on the global economy?
I think in many ways, the situation in the Strait is at its most dangerous point in at least the last 20 years, maybe even more dangerous than that. If we imagine this as three sides to a triangle, each side of the triangle is kind of moving away from the other. So you have in Taiwan increasing affiliation with a different sense of what Taiwan is and Taiwan's democratization, and an increasing sense that Beijing more recently has been less friendly and more of a foe towards Taiwan. In Beijing, you have increasing sense of concern about Taiwan's trajectory, and also an affirmation that Chinese leaders don't want to hand this issue off to the next generation, as they've said quite clearly. And then in Washington, as we've already been discussing, there's that growing tension with China and growing distrust of China, and in particular, a concern about developments in the Strait, because that could be a major point of crisis, not just between Taiwan and China, but also between the US and China. If a crisis were to break out, I think it's really difficult to understate the risks for the global economy. If we take a look at just one side of that triangle, at Taiwan, and just one thing that Taiwan makes, granted, a very important thing that they make a lot of, which is semiconductors, the number of sectors that rely on Taiwan's both cutting edge and more mature nodes, it's everything from smartphones to PCs, home electronics, and autos. Already you have a huge portion of global output and a lot of services that rely on those products. If Taiwan's supply of chips were to be impacted in any way, and in particular if it were to go offline, I think the implications for the global economy would be huge.
So I think we found some reasons for cautious optimism about China's medium to long-term growth prospects on the panel today. I also feel that for myself, any discussion of China's economy right now is a little bit tinged with sadness, as we remember Premier Li Keqiang, a man who gave so much to the cause of China's development and left the world far too soon. Now, those who met Premier Li talk of a man of fierce intelligence, of deep commitment to China's development, and someone who was always eager to absorb new perspectives, new ideas, advice on China's development trajectory. So as we wrap up today's panel, I'd like to come to each of you with the same final question. What one piece of advice would you like to give to Beijing, or to Washington, D.C. as it thinks about its China policy, or to businesses and investors as they attempt to navigate the complexity of the Chinese economy today? Ben.
I have two short stories to share. One is back in 1806, East Indian Company set up their East Indian Company College near London, recommending to the government, the UK government, the British government, to set up the civil service system based on the national examination system they want to learn from China. It was Qing Dynasty. It was before the Opium War. So that exchange of ideas and the exchange of culture happened during the most unimaginable time. And the second question is, the second story is John Murray Forbes, who was part of the Forbes family in Boston. He first started his career in Guangzhou in 1834, I believe. Then he returned to Boston in 1850, bringing back the money he made in China, and also $500,000 given to him by his mentor, the Chinese mentor, Hoka. The money was invested in Chicago railroads. And the railroad system went beyond Mississippi and afterwards. And John Murray Forbes became the chairman of National Committee of the Republican Party in the U.S. And that was right around the Opium War period. So what I'm saying is, people have to go back to history and learn from history. We will, once we study history, we know the interactions, the collaborations, the investments never stopped. Even at the time we don't even remember, we don't even imagine that things would happen that way during that time. So the last advice to the people is, stay connected, stay invested, or you will regret it.
Gary.
So the advice would be, don't try for the grand bargain. I don't think you're going to have a very, very broad-based agreement on hundreds of points. Right before this session, there was a very, very important initiative that has been sponsored by Bloomberg, Asia Society, Chinese counterparts, McKinsey, and so on, Bayer, and it's on cancer. And it's the largest cause of death in China. It's the second largest cause of death in the United States. And it's an initiative to normalize guidelines around data and being able to actually solve this, not for the US and China, but actually bring that to the rest of the developing world. Find things like that, where the two governments can actually say, this is a win. And if after 5 or 10 years you have 8 or 10 of those, that'll become the norm for the conversation instead of all the things that aren't working in the relationship.
Jenny.
I think as someone who's worked now across both these communities, the U.S. policy world and now the private sector, I've been firsthand witness to the gulf between the two and the lack of communication that often happens. And my advice would be to the business community, as we've been discussing all day today, geopolitics is back. Whether or not we like it, it's here. And I think it benefits all of us to try and understand and get inside policymakers' heads of how they're looking at the world, because inevitably steps they take are going to influence economics. And then for my former policy colleagues, I would just reinforce the importance of talking to the business community. They aren't just stakeholders in major issues like the U.S.-China relationship, but they're also actors with their own agency, their own role to play in that relationship, and they have a lot of unique and important insights to bring, in particular on the economic implications of policy steps.
Fred, the last word to you.
Well, for politicians, diplomats, and the security experts, I would say, it's not everything's a zero-sum game, right? So always keep it in mind. And second, for business and investors, definitely, despite all the short-term uncertainty challenges, like any other larger complex economy, China has its share of difficulties and challenges. But China also has enormous resources, capacity to deal with the challenges, and still untapped long-term growth potential. So the advice is very simple. Invest in China.
Keep talking. Deliver small wins, even if you can't deliver big wins. stay invested in China's long-term potential. Wise words from our panel, Benjamin Deng, Fred Hu, Gary Reichel, Jennifer Welsh. Thank you very much.